Welcome to the second little lecture in Module 1. And remember where we left off before. We were looking at the criteria for how to ascertain the level of globalization that has occurred. We've talked about trade flows. Now, I briefly want to talk about capital flows and very briefly about the flow of people and labor. So capital and labor, they're both what are called factors. And we need capital to invest in new plants and equipment. We need workers to work. So those are both factors of production. And how mobile those factors are is a good indication of how well economies are integrated. And as a general rule, the more integrated economies become, the easier it is, and the more capital and labor both flow across international borders. In general, labor mobility is less than capital mobility. It's important and interesting to note that for the U.S., there's less labor mobility now than there was 100 years ago. Just think about Irish immigrants coming into the U.S., Ellis Island, all the tens of thousands of people that came through in the latter part of the 1800s. Much more restrictive now than it was then. So at least in and out of the United States, labor mobility is much less now than it has been. Capital mobility is higher, not only for the U.S. but for other countries as well. So there's two types of capital that we want to keep track of, and these will be important as we go through the class. So the first is paper assets. So it's stocks and bonds, bank accounts, the flows of those kinds of assets. And last time we talked about how foreigners can invest in U.S. Treasury bonds or U.S. corporate bonds, U.S. stocks, and we can invest in similar assets over there. So there's the flow of these paper assets. We can also invest in physical assets. So a U.S. company can buy production facilities, factories, agricultural acreage, etc. In other countries. So that's when a company in the U.S. makes an investment in physical capital, factories, businesses, real estate, etc. That's termed foreign direct investment. So we track that so the foreign direct investment from the United States to other countries, and also the other countries that foreign direct investment into the U.S. So two things we need to keep in mind, how much more or less are capital flows now than they were in the past. A lot of it depends on how much savings versus consumption is occurring in a country. The more savings there are, the lower consumption. So the higher the savings rate in a country, there's more capital available, and so then there's more investment and increase in capital flows. So that's one. So that varies over time. Technology has improved over time, so that's tended to increase capital flows. And further, relative to what there was before, there's a lot more types of financial investments and instruments available, a lot more foreign exchange transactions. And when we get into the foreign exchange markets, we'll see that the largest markets in the world are foreign exchange markets. They dwarf the volume of trades in stock markets. And one reason is because the cost of conducting transactions either in the foreign exchange markets or making financial investments across national borders have come down significantly. So that's key. So we have our three questions. What is globalization? So we looked at trade flows, briefly on capital flows, very briefly on labor flows. So how mobile are those types of things? And then the second question as we want to address now is, has it been increasing over time? So let's just take a quick look. And so the book talks about how there was the first phase of globalization. We'll get into that in a little bit. First phase of globalization from the mid-1800s through World War I. Then there was a dramatic decline. And then since World War II, it's been increasing. And so one way we know this is the amount of world trade has grown faster than the amount of world output, or GDP. And so here's a little statistic. In 1950, the amount of world trade was about 5.5% of world GDP. By 2010, it had increased fourfold to 20%. So the amount of world trade relative to GDP has increased a lot. So for the world, the amount of global trade has increased, and so one way is like, what's the percentage of GDP that's accounted for by international trade? But just another way of looking at it is world GDP has grown by a factor of 8 since World War II. The amount of world trade has increased 24 times in that same period of time. So the amount of world trade relative to the GDP growth is significantly higher. In the United States, similar story. 1950, imports only constituted 4% of U.S. GDP. Now it's about 15%. That's just imports. If you count exports, it's significantly higher. As we talked about before, the sum of those two is about 25% of GDP. So here's, since 1950, here's the growth of exports and imports over time. As we can see, it's significantly higher now than it was before. So what's going on? What's driving this? We talked briefly before about the technological changes, so we'll look at those real quickly. The types of trade agreements, both at the multilateral level and the regional level, has been huge. And like we mentioned before, lots more different types of investment vehicles are available, and dramatic development and increase in the types and numbers of international financial markets. So those are all key, so we'll keep those in mind. So as the book talked about, the first wave of globalization, so I'm just going to call it from 1870 to the start of the First World War. We had lowering of trade barriers, technological developments that we had talked about before in the intro, dramatically reducing transportation costs. So we mentioned before about the change in shipping from sailboats to steamships, dramatically reducing the time to go across oceans and the reliability. Once they got to one coast, transcontinental railways make it easier to move goods. And then we also mentioned about the telegraphy, the speed of communication. So both of those dramatically reduced transportation costs, increased efficiency and speed. So as we talked about during this period, exports as a share of world income increased. So it doubled in that period of time. Per capita income started increasing rapidly relative to what they were before. Per capita incomes were rising at less than 1%, so 0.5% per year. Now per capita income is rising at 1.3%, along with the increase in amount of world trade. So that's key to keep in mind, is as world trade increased, so did GDP per capita. So people were getting better off as a result of the increased trade. And the nations that were active participants in international trade did a lot better than those that were not. And as the book talked about, this came to a screeching halt in World War I. Then from World War I to World War II, I call it the return wave. So there was the tide of increasing globalization. This was kind of the tide going in the other direction for a while. There was, after World War I, increased pressure for protectionism, protecting domestic jobs from foreign competition, isolationist, and all through the 1920s, these sentiments were rising, and they resulted in the huge tariffs that resulted in 1929 called the Smoot-Hawley tariffs. So They were proposed in 1929, passed in 1930. Huge increases in the amount of tariffs. So average tariffs increased 60%. That was U.S. tariffs on imported goods. Our major trading partners retaliated with high tariffs on our goods, and international trade was dramatically reduced. One of the major causes for the Great Depression. And what was the rationale? We were trying to protect our domestic workers and markets by shielding them from international competition. What we wanted to do was have high tariffs on imported goods, protect our domestic workers, and promote exports. But that got shut off when our trading partners retaliated. And so that was, as I mentioned, it led to a global, worldwide, dramatic, nasty depression, and it lasted for a long time until the end of World War II. After World War II, then countries said, that wasn't such a great idea. Let's do something differently. So here's what this is in your book, but it's the different tariffs that were enacted in the United States. And so here's the Smoot-Hawley tariffs. So in 1930, and then since then, reduction. And here's the GATT, which is the General Agreements on Tariffs and Trade, the precursors to the World Trade Organization. So these are the different rounds of negotiations aimed at reducing trade barriers. And then the World Trade Organization began at the end of the Uruguay round and continues today. So relative to what they were before, since World War II, dramatic reductions in the amount of tariffs. That's huge. We will look at that later on in the course too. So the first wave of globalization was, mid-1800s to World War I, reduction between the two world wars. Afterwards, then this was called the second wave of globalization, and as I mentioned, we kind of learned our lesson in terms of the effects of high tariffs. So along with the reduction in tariffs and trade barriers, there was falling transportation costs, increased productivity in transportation. So here's a little slide that I have. So what have we had since World War II? We've got containerization, huge. So you can load up over 5,000 containers on a ship and ship them to the United States from, this is Hanjin Shipping, this is the Port of Seattle. We visited last fall, and so you have each container taken off the ship, put on a semi truck, and shipped directly to Boise, Idaho, for example. All the goods in that particular container going to the same spot. They get unloaded at Walmart, put on the shelves. Huge efficiencies. We also have, since World War II, the development of the jet engine and air transportation. Like I said, dramatic reduction in trade barriers and increased efficiency in terms of tracking shipments. And friend of mine, so here's a truck and a laptop. Friend of mine's a truck driver and has a route from Brooklyn, New York to Phoenix, taking vegetables. And he said before 2000, he would load up a load of vegetables in Brooklyn and drive them to Phoenix. It would take him 3 days on average to line up some return loads because he doesn't want to drive back to Brooklyn empty. So he takes him 3 days to line up return loads, drives back to Brooklyn with stuff going from Phoenix to New York. He said once the advent of the internet came along with laptops, he said he lines up his return loads on the way. When he gets from Brooklyn, when he gets to Phoenix, he unloads and he has his return loads already lined up. He loads them up and he's back on the road the same day. So huge increases in efficiency and productivity. So there's been, since 1945, in the second wave of globalization, there's been a difference between how it's affected developed countries versus developing countries. So for developed countries, things have gone pretty well. So there's been an increased trade of manufactured goods between developed countries. So between, for example, the U.S. and the European Union, increased in trade of manufactured goods. Trade barriers have been reduced dramatically. And so as a result, developed countries have specialized in certain manufacturing niches, and they've gained through economies of scale in those industries. And we have some firms clustered. For example, the U.S. auto industry has manufacturing facilities in the United States, in Michigan, also in Canada. Huge amount of back and forth. So by the time a car is manufactured, supposedly in Detroit, it's gone back and forth across the Canadian-U.S. border several times. For developing countries, it's a little bit different. So they did not benefit as much in terms of, or from the growth of global trade in manufacturing and services, because they don't have those industries developed as well. And when they did try to enter the production of manufactured goods, and they tried to export those to developed countries, there were barriers. So developed countries lowered their barriers with each other, not so much the barriers with developing countries. And also, they didn't benefit because in a lot of developing countries, it's not a good investment climate. If property rights are insecure or the infrastructure doesn't exist, it's risky to invest either paper assets or foreign direct investment in those countries. And like I said, a lot of times there were anti-trade policies in developing countries against each other. So that was one problem. And then also another issue is that they produce primarily agricultural products and natural resource products. Those are the types of products that countries, especially developed countries, maintain relatively high trade barriers. So for the United States, for example, and Europe, we have relatively low barrier tariffs, for example, on manufactured goods. We have relatively high tariffs on agricultural goods because we try to protect our domestic farmers. And so in a developing country, they're producing agricultural products or products that are produced from natural resources. They're trying to export those things to us. Those are exactly the kinds of things that we try to protect our domestic producers. So the developing countries, for the most part, do not benefit from globalization as much as the developed countries. Over the last probably 15 years, there's been some change, and so there's been a growth. First, there was a growth of the high income earning Asian countries, Korea, Taiwan, Japan. That's kind of spread now. So we have obviously the dramatic growth in China, India, and Brazil. So the BRIC countries are starting to benefit, and they've entered the world markets not only in agricultural and commodity types of goods, but also in manufactured goods. And in other developing countries, especially those that are relatively labor intensive, they have a comparative advantage in those. And so we see a lot of countries like Bangladesh, Malaysia, Turkey specialize in relatively labor-intensive manufacturing activities where, because they have relatively cheap labor, they benefit. And they've also been lowering their benefits to foreign investment. They've lowered their barriers and tried to make technological progress in transportation and communication. Other developing countries have not fared as well. And especially in sub-Saharan Africa and other places, the benefits of globalization haven't really come to them. So that's the end of this lecture, and I wanted to pick up on that theme on the next one.